Fed meeting news today. FOMC leaves interest rates steady, projects 3 cuts in 2024. Powell says hikes likely over. Powell on the Fed's latest decision on rates. No one is declaring victory. Fed holds rates steady, signals 3 rate cuts in 2024. Minor changes to the wording of the Fed's closely watched policy statement signaled the shift, and Chair Jerome Powell said officials believe that our policy rate is likely at or near its peak for this tightening cycle. Key events. Investors are penciling in even more cuts to interest rates following the latest news on monetary policy from the Federal Reserve. Officials' median estimate now calls for the federal funds rate to end 2024 at 4.6%. Implying 3/4 point cuts from the committee's current target range of 5.25% to 5.50%. Markets took an even more dovish message from the committee's statement announcing the decision, its economic projections, and a press conference from Federal Reserve Chair Jerome Powell. It would likely take faster than expected progress on returning inflation to the Fed's 2% target, or a more severe economic downturn in 2024, to get that kind of easing of monetary policy. While Federal Reserve officials expect the preferred inflation gauge will be at 2.4% at the end of next year, still above the bank's target of 2%, policymakers will start cutting rates well before it hits that goal, Chair Jerome Powell said Wednesday. The reason you wouldn't wait to get to 2% to cut rates is that would be too late, he said. You don't overshoot. The US economy has been surprisingly robust in the wake of the COVID-19 pandemic, but many indicators are now showing growth in real gross domestic product is moderating. That could mean that it takes longer to get to 2% inflation, he said. We're moving carefully at this point, Powell added, saying that while the bank is making strides in tamping down inflation, it isn't quite enough. We're pleased with the progress and we see the need for further progress, Powell said. I'm not calling into question the progress, it's great. The US is holding presidential and congressional elections in November 2024. A strong economy has historically been an advantage for incumbents. Federal Reserve Chair Jerome Powell pushed back on the idea that the US economy is currently in a downturn, despite consumers' pessimism. He noted that while there is always a probability that there will be a recession in the next year, and it is a meaningful risk no matter what the economy is doing, he still sees a path toward a so-called soft landing, where the Fed is able to bring inflation down to its 2% target without a huge hit to economic activity. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles, Powell said. Powell noted that Fed officials included the word any before mentioning additional increases in interest rates in its statement, saying that it was an acknowledgement that while members didn't see the need for additional increases, at least some participants didn't want to take the possibility of further hikes off the table. The median forecast in Federal Open Market Committee members' latest summary of economic projections, published on Wednesday, calls for a federal funds rate of 4.6% at the end of 2024, versus 5.1% when officials last gave forecasts in September. Estimates range from 5.4% on the high end to 3.8% on the low end, but with 16 of 19 members' forecasts falling within the narrower range of 4.3% to 4.9%. Forecasts diverge from there. The median estimate in the so-called dot plot for the Fed funds rate at the end of 2025 is 3.6%, down from 3.9% in September. Another 2025 dot is at 2.4%, a hefty gap of 3 percentage points between the two outliers. The remainder of the dots are between 4.4% and 3.9%. Fed officials did update their forecast for the long-term median unemployment rate to 4.1%, up slightly from the 4% in September's projections. Policymakers expect the core personal consumption expenditures price index, which excludes the more volatile food and energy costs and is considered a better indicator of inflation trends, to end the year at 3.2%. That's significantly lower than the 3.7% year-end rate Fed officials were anticipating earlier this year. The pace of year-over-year growth in core PCI is expected to slow to 2.4% by the end of 2024, a slightly faster deceleration than the previously anticipated 2.6% rate next year.